Welcome to week 11. This week we're going to be taking a look at chapters 15 and 16. Chapter 15 is more self-explanatory than chapter 16, so I'm going to be focusing most of my discussion on the material in chapter 16, which looks at monetary policy. So this week we're looking at the concept of money in banking. I'm not going to be able to lecture on all materials I just mentioned, so please read the chapters carefully, but let's focus on some important concepts while we have time. So fractional reserve banking is what creates money, and it operates so through the money multiplier. The money multiplier defined says that any change in quantity of money that is generated when an additional dollar is added to the system would be based on the money multiplier. And that money multiplier will tell us how much of a change in quantity in money we see when there is an additional dollar added to the system. So the formula for the money multiplier is our reserve ratio, is 1 over the reserve ratio. And the required reserve ratio is the amount of reserves that must be kept in the bank in the form of cash on hand or an electronic balance held at the Fed. And that reserve ratio is based on how much they've taken in deposits. So let's look at how this works. Okay, so required reserves are the amount of reserves required to be held on deposit with the Fed or in cash, in vault cash, and they represent a ratio of the total deposits that are taken in. So if we look at a bank and its assets and liabilities, and here we're kind of excluding equity, which assets equal liabilities plus equity. So for example, with a required reserve ratio of 10%, how much additional money is created by a bank receiving a $10,000 deposit? So what is the process for understanding the transmission of increases in the quantity of money through the entire economy? So let's assume this $10,000 deposit comes in. Someone receives a check from their grandmother, and they're going to deposit it into their savings account. So at first, it becomes a deposit into the savings account and in the amount of $10,000. And that would be a liability of the bank. So deposits are a liability of the bank because they are demandable. So upon demand, the bank has to give the cash back or a check back to the individual who's deposited with them in their savings or checking account. So now we can kind of get into looking at the reserve ratio. So initially what will happen is that all of that $10,000 deposit will hit the bank, and as we always have to balance the asset and liabilities sides of a balance sheet, it will hit the bank as reserves. So we'll see an increase in $10,000 of reserves. But the bank is only required to hold 10% of their deposits as required reserves. So really we have two things going on. We have excess reserves and we have required reserves. And so the reserves will actually be comprised of what is required to be held and what is in excess. So 10% of 10,000 is going to give us $1,000. So they're only really required to hold $1,000 of the $10,000 deposit, and $9,000 will go into excess reserves. So you can see that 9,000 and 1,000 equal 10,000, and the required reserve ratio of 10% tells us that this new deposit coming into the bank, we're going to be required to hold 1,000 or 10% of that new deposit in our required reserves, and the rest can go into excess reserves. And the bank is going to say, well, what I'm actually going to do is I'm going to lend this out, because if I have this money on deposit, hopefully it will not be demanded, but we're talking about lots and lots of deposits over lots and lots of individuals. I'm going to be required to keep $1,000 of that $10,000 on reserve with the Federal Reserve, but the other $9,000 I can lend out. So I'm going to make $9,000 of loans, and on that $9,000 of loans, I'm going to earn interest, and that's one of the ways the bank earns income, is it earns interest in excess of what it has to pay out on its deposits. If you look at your savings or checking accounts, you'll see that the interest that's being paid out is very, very low, and the assets of a bank, being the loans, tend to be things like home loans, which have a much higher rate of interest which people are paying on. So that's sort of the first step which will happen. If you think about it, then what happens is that when these loans are made out, say $9,000 loan is made out, and it happens to be part of a home loan, because a lot of these deposits are coming in, right? So they'll then get deposited on the liabilities side of another bank, in which some will be required to be held in excess. It will all flow into excess and then some in required. And when the excess reserves, trigger, the bank will say, okay, I have excess reserves, I'm going to lend these out. And the same process happens again and again. So the way for us to solve this formula or solve this problem is to see first what's initially happening. We understand how there is an increase in money, because initially there was only a $10,000 deposit, but now that loan is then going to be deposited again by someone else who's used it to pay for something, and there will be $19,000 of total deposits. So that initial $9,000 will fall into required and excess, and of that $9,000, only $900 is required to be held in required reserves. So our required reserves will increase by $900, and 9,000 minus 900 will have another 8,100 in excess reserves. Now, we're not going to keep our reserves in excess reserves, right? We're going to lend them out. And so we'll add that to the balance. So we'll now have 17,100 in total loans being made on that initial $10,000 deposit. So that's what's happening to show that the money supply is dramatically increasing from just one $10,000 deposit. And the way we can solve for it, because this will happen infinitely, is to take our money multiplier and multiply it by the amount of the initial deposit. So 1 over the required reserves, otherwise known as our money multiplier, times the change in deposits will show us how much the money supply has expanded. So 1 over our required reserve ratio of 1 over 0.1 gives us 10 times that initial $10,000 deposit equals so there will be an increase in the money supply of $100,000 with a $10,000 deposit into a bank in a required reserve ratio of 10%. We could look at more rounds of this. I suggest you do so. Think about the fact that a 17, now we have an additional, it was $8,100 being deposited, because it's going to be an additional loan made out, and when someone pays for whatever they're using to enter into a loan, so they're paying for the home that they are purchasing with the loan, then that becomes a deposit on the liability side of another bank, or it could be this bank, for example. And then how does that affect the excess or required reserves, and then what happens with lending because of that? So this kind of looks at our, helps us better our understanding of the fractional reserve system and the creation of money because of the fractional reserve system. So now the implication of this is that we have a central bank, and our central bank is called the Federal Reserve Bank, and it has three tools of the of the Fed that can be used to alter the money supply. They can use open market operations, which is the buying and selling. They can also alter the reserve requirements. So or they can change the discount window. So the discount window is where you can borrow funds from the Fed. So you can actually go to the Fed and say that you need to borrow funds at a certain interest rate, which is called the discount rate. And you can go to this discount window to borrow those funds to meet your required reserves. Say you're short on reserves one evening or for a certain period of time. So by performing open market operations, changing the reserve ratio, or changing the discount rate, the Federal Reserve is able to alter the supply of money as it transmits through our fractional reserve banking system. Now, let's take a look at how their policies work. So an expansionary policy would be one where the Fed, in an expansionary monetary policy move, will decrease interest rates in an attempt to increase aggregate demand. And they're going to do this primarily through consumption. In contractionary monetary policy, so with expansionary monetary policy, what we're essentially concerned about is low economic growth. Economic growth, we can actually be in a recession, so we're short of full employment, real GDP. And we have unemployment. So when we have unemployment or low or negative growth in real GDP, the Fed will intervene in an effort to decrease interest rates, which should increase aggregate demand. Contractionary monetary policy is used. So they will increase interest rates, which should aggregate demand, and this is done also through consumption. And we will pursue, the Fed will pursue contractionary monetary policy above potential real GDP, and we have inflation. So the primary concern would be inflation, which would trigger contractionary monetary policy. So we've defined these different policies. Put that here. And let's look at a balance sheet and take a look at how open market operations would work. So we'll go through the transmission of open market operations as it applies to expansionary or contractionary monetary policy. So the way it works is that in open market operations, remember that the Fed is going to buy or sell treasury securities to influence the money supply. When we influence the money supply, we influence interest rates. When we influence interest rates, we influence consumption through the aggregate demand curve. So if the Fed buys $1,000 of bonds from Bank A, how does this affect the quantity of money in circulation? How does doing this really, how does it lower interest rates and increase aggregate demand to hopefully bring us to a level of full employment, real GDP that we're comfortable with? So initially, let's look at this bank. Let's assume that this particular bank has, and they also have some equity. So knowing that assets equal liabilities plus equity, we have a bank that has $9,000 of deposits. So we're simplifying these numbers. And they have $7,000 in loan assets. So they've lent out $7,000 that they're earning interest on. And they have required reserves of $9,000. So for example, they have a 9% reserve requirement here. And, or more than 9%. They also have bonds in their asset portfolio. And when we add up all of the loans, reserves, and bonds, 7 plus 1 is 8 plus 2 is 10. And we add up the liabilities plus net equity, our balance sheet balances. So if the Fed buys $1,000 of bonds from Bank A, what happens here? So the bank will sell $1,000 of their bonds. So we'll take out $1,000 of bonds, and we'll be left with $1,000 in bonds. This will increase our reserves by $2,000. But based on the amount of deposits we have, or by $1,000 to $2,000, based on the amount of deposits we have, we actually will have $1,000 of this in excess reserves. So we don't need to hold excess reserves, and what we'll do with that is we'll increase our loan portfolio. So actually, we'll increase the amount of lending we're doing, and we'll lend out $8,000. We'll be lending out $8,000 instead of $7,000. Our excess reserves will go away, and our reserves will fall back to $1,000. So what happened here? What happened was that we were selling some of the bonds that we had to the Federal Reserve. And when we sell those bonds to the Federal Reserve, we are no longer required to, we now have a different amount of money that we're able to balance against our deposits for our required reserve ratio. So required reserves must be held as balances at the Fed or in vault cash, but bonds don't qualify as vault cash. So if we're holding bonds, they don't serve as a reserve. But once we have more cash, it falls into our excess reserves and can then be lent out. Now that additional loan, that additional $1,000 loan that was bonds and then excess reserves and now a loan, will then become a deposit on the balance sheet of either this bank or another bank. It will then hit excess reserves of a bank and also the required reserves. And the amount of excess reserves that additional $1,000 is will then be lent out, and so forth and so on. So when we have expansionary monetary policy, the Fed will use open market operations to buy bonds. This increases the money supply because we see that more lending is occurring. When more lending is occurring and the money supply increases, so our supply of funds would shift to the right. So the loanable funds market can be described as the available supply and demand for money. So the supply of money is going to be provided by those who are doing the lending, and the demand is going to be done by those who are doing the borrowing. So traditionally, we see banks lending and consumers borrowing. And the Federal Reserve is going to provide us with our primary source for loanable funds, and they will determine the amount of supply of money in the system because they are able to alter it with the discount rate, with reserve requirements, and with open market operations. So one thing we notice is that, I'm just trying to put quantity of money down here on that. Quantity of money is on the x-axis here. So when the Fed increases the supply of loanable funds or money, then we see that interest rates fall. When they decrease the supply of loanable funds or money, we see that interest rates rise. So therefore, when the Fed goes in and buys bonds, which add money to the system and allow for more lending to occur, more depositing and lending and depositing and lending, etc., expanding the money supply through the system of fractional reserve banking, contingent on the reserve requirement, which gives us our money multiplier, we see that increases in the supply of money will decrease interest rates. When interest rates are lower, this allows consumers to purchase more goods and services. Think about your home, a mortgage payment you might have. If interest rates are lower on the value of your mortgage, then that means, ceteris paribus, that you have more money to spend on all other goods and services because you're paying less interest every month. Now, if interest rates were to increase, then, and most mortgages are fixed, but if it was a floating mortgage or an adjustable rate mortgage, you would see the interest increase on your monthly mortgage payment every month, and that increase in interest would actually mean that you would have less money, ceteris paribus, to spend on goods and services. So when the Fed increases the supply of loanable funds by buying bonds and injecting money into the system, which is then deposited and lent and deposited and lent, interest rates fall, and when interest rates fall, consumers will buy more goods and services. This should shift aggregate demand through consumption, since aggregate demand is the combination of consumption, investment, government expenditures, and net exports. And if we change any of those variables autonomously, we will see a shifting of the aggregate demand curve. The idea with expansionary monetary policy is that say our long-run aggregate supply curve is this purple line here, and we are short. So this area here representing our GDP gap, and therefore we have cyclical unemployment. We have goods and services not being produced with available land, labor, capital, and technology that could be produced if our aggregate demand curve shifted outward. So when the supply of loanable funds increases, dropping interest rates, it increases consumption, a component of aggregate demand, and hopefully reduces unemployment, increases real GDP, and brings us to our long-run intersects with our long-run aggregate supply, where any other increases in aggregate demand would really just increase the general price level, and decreases short of long-run aggregate supply or full employment real GDP means that we have unemployment. So in conclusion, this discussion went through looking at what the money multiplier is and how this concept is affected by or affects the fractional reserve banking system. So we needed to learn a little bit about, well, what is the money multiplier? What's the formula for this concept? And what are reserves? What are required reserves? How are required reserves held in a bank when new deposits are made? And when a new deposit is made into a bank based on the amount of required reserves that are to be held as a deposit with the Fed, through the multiplier, how does this influence the size of the money supply? What is the change in money supply? And then we kind of looked at the Federal Reserve and their three policy tools for influencing expansionary or contractionary monetary policy. And we went through an example of expansionary monetary policy and the transmission mechanism through which aggregate demand increases to hopefully bring us to an equilibrium production of full employment real GDP. So if you have any questions on this material, please don't hesitate to contact me. Also, I suggest going through an example of contractionary monetary policy on your own. And please ensure that you understand what happens when new deposits are made as they affect the asset and liability side of a bank bank's balance sheet and how the bank responds to this deposit. Again, please let me know if you have questions, and I hope everyone has a wonderful week. Thanks for listening.